Hey everyone, welcome to Trader DNA. In this video, I'm going to share the simplest and proven profitable trading strategy with a high win rate. But before we get into it, make sure to click subscribe and turn on the notification bell so you won't miss any of my latest videos. So, without further ado, let's dive right into the video. In this trading strategy, we'll be using two indicators, namely MACD and stochastic oscillator. This trading strategy is incredibly powerful because it's easy to implement thanks to its straightforward concept. It's this simplicity that has enabled its users to maximize profits in the stock and Forex markets. So, here's how the strategy works. The first step is to determine the current trend. This can be done by observing the MACD histogram. If the MACD histogram is below zero, then the current trend is bearish. And if the MACD histogram is above zero, then the current trend is bullish. Why the MACD histogram? To understand the MACD histogram, let's break down an MACD chart. It consists of three components: the MACD line, a signal line, and a histogram. These are plotted along a horizontal axis called the baseline. Typically, the MACD chart is displayed just below the price chart of the security, allowing for easy comparison between price movements and changes in the MACD chart. The MACD line is calculated by subtracting a longer-term exponential moving average or EMA from a shorter-term EMA. Generally, the 12-day and 26-day EMAs are used based on the closing prices of each candlestick. The signal line is derived from the difference between the two EMAs and is further smoothed using a 9-period moving average. Thankfully, there's no need to manually perform these calculations, as advanced charting software simplifies the process by instantly providing all the necessary values and even offers back-testing capabilities. Finally, the histogram is obtained by subtracting the signal line from the MACD line. It offers a clearer interpretation compared to analyzing the two lines individually. Therefore, if the MACD histogram is below zero, the current trend is bearish. Conversely, if the MACD histogram is above zero, the current trend is bullish. Let me show you what I mean. This chart indicates that the market is moving up, which we can see from the MACD histogram. When the MACD histogram is above zero, it's a signal to focus on finding opportunities to buy. And the best time to enter a buy position is after a pullback. In this example, the MACD histogram is above zero, suggesting a bullish trend in the market. Once the pullback is over and the MACD histogram stays above zero, it's a great chance to place a buy order because there's a high chance that the price will continue going up. As you can see on the chart, we made significant profits while effectively managing the risks involved. Next, let's take a look at this chart. The MACD histogram is below zero, which means the market is currently showing a bearish trend. We can see that the market is going through a correction, but the MACD histogram remains below zero. This indicates that the bearish trend is strong, and there's a high chance that the market will continue to be bearish after the correction ends. In this situation, when the market correction or pullback is finished, and the MACD histogram continues to stay below zero, it's crucial to open a sell position right away. This is because there's a good probability that the price will continue its bearish trend. As you can see on the chart, the price quickly drops, and we make significant profits compared to the risks we took. The rules I explained earlier are basic and not perfect yet. However, you can already see that this strategy can easily and quickly generate profits in both the Forex and stock markets. From what I explained earlier, you now understand the main secret power of the MACD indicator. Now, let's delve deeper into the capabilities of MACD. We will discuss pullback and how to identify the most profitable pullback for each trade you make. So, how to determine if a pullback has ended and the trend will continue? There are two important things to consider when it comes to pullbacks. First, we need to evaluate if the pullback is big enough to offer a greater reward compared to the risks involved in trading. If the pullback is not strong enough, it's better to disregard it because the potential profit is usually small as well. That's why in this strategy, we only enter the market when the ongoing pullback is substantial. Now, how do we determine if a pullback is significant or small? The answer lies in using the stochastic oscillator. If the market's stochastic oscillator is showing a bullish signal and it experiences a pullback that drops below the 50 level, then that pullback is considered significant. On the other hand, if the stochastic oscillator experiences a pullback but remains above the 50 level, then the pullback is considered small and doesn't require much attention from traders. Let's take a look at this example. The market is currently in an uptrend, which is indicated by the MACD histogram being above zero. As we discussed earlier, when the MACD histogram is above zero, we focus on finding buy signals. The most advantageous time to enter a buy position is after a significant pullback. In this case, you can observe that after the market experiences an uptrend, as shown by the MACD histogram above zero, the price starts to decline significantly. This is evident by the stochastic oscillator dropping below the 50 level. It's important to note that despite the price decrease, the MACD histogram remains above the zero level. So, this significant price drop is known as a pullback or price correction. Once this pullback comes to an end, it provides an excellent opportunity for a trader to enter the market by opening a buy position. Remember to place your stop loss below the swing low and set a profit target that is 3 times your risk. As you can see, the price swiftly rises following the pullback, indicating a continuation of the bullish trend. The second point is knowing when the pullback is likely to be over. To determine the end of a market correction or pullback, we look for a crossover between the fast stochastic and slow stochastic lines. What makes the stochastic oscillator used in this strategy different is its setting, which is 8-6-3. This unique setting allows traders to easily spot the crossover between the fast and slow stochastic lines. With this clear signal, traders can confidently enter the market without any doubts. Next, based on the stochastic oscillator's crossover on this chart, we can conclude that the pullback or market correction has come to an end. Thus, it's time to take action and enter the market by opening a buy position at this point. Next, we should promptly set our stop loss and profit target. The result is that the price swiftly continues its bullish trend, and as a result, we achieve a substantial profit compared to the trading risk we took. This trading strategy is fundamentally based on signals from 2 indicators, namely MACD and stochastic oscillator. However, if you want to increase your chances of winning each trade, you can integrate price action variables into the strategy. For example, you may only enter a position if there is a supporting candlestick pattern. If no such pattern is present, the signals generated by MACD and stochastic oscillator are disregarded. Let's take a look at an example on this chart. The MACD histogram is below the level 0, indicating a bearish trend. Additionally, the stochastic oscillator shows a significant market correction or pullback, with the indicator rising above the level 50 and continuing upward. It's important to note that this is not a market reversal, as the MACD histogram remains below the level 0. Moreover, the fast stochastic crosses below the slow stochastic, happening above the level 50. Based on the signals provided by MACD and stochastic oscillator, traders should promptly open a sell position, as the market is expected to continue its bearish trend. Since you want to incorporate price action variables into your trading decisions, the bearish engulfing pattern serves as your price action signal. After spotting the engulfing candle, you can immediately execute a sell position. As always, make sure to set your stop loss at the nearest swing high, and aim for a take profit level that is 3 times your stop loss. Typically, the price continues its bearish trend quickly, resulting in significant profits within a relatively short period. As we've observed together, this trading strategy has proven to be exceptionally powerful. It is straightforward to comprehend, easy to implement, and boasts a high probability of success. You may recall the saying, the greatest ideas are the simplest, and that applies precisely to this trading strategy. By applying a simple trading strategy, we can maintain discipline in following the established trading rules. You can easily implement this strategy on any trading platform you use. Alternatively, if you wish to use the exact settings demonstrated in this video, you can download them from the description. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so you don't have to worry about anything. Get the download link in the description. As always, if you've learned something new or if you want more videos more frequently, make sure to subscribe, click the notification bell, and share this video on your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.